Why does the middle class often invest so poorly? It's a blunt question, but one worth asking honestly, especially today when the middle class invests far more than ever before. Life insurance, rental properties, stocks, crypto, the opportunities are numerous and increasingly accessible. Yet, despite these tools, many households struggle to build truly solid wealth. This is a paradox we aim to unravel in this video. It's not that they are unintelligent, nor that they don't work hard enough, it's that they are often steered towards investment choices that are simply poor, or even bordering on scams. I'll explain all of this, and towards the end of the video, I'll tell you how to correct course and aim for over 10% annual returns. By investing €300 per month with such a rate, you could accumulate €618,520 in 30 years. If you then take 5% of that sum annually, which is easily achievable if you're generating 10%, you could become financially independent, receiving €2,578 per month for the rest of your life, in addition to having an inheritance to pass on to your children. But before we get there, you'll need to avoid a few critical obstacles. The first obstacle is the quality of advice. Most people don't spend hundreds of hours educating themselves about investing. Instead, they seek advice from those around them, their banker, a financial advisor, a family member, or a friend who knows a bit. The problem is that many of these individuals are not true investors but product salespeople. A banker, for example, is often there to distribute their bank's products, life insurance policies laden with fees, proprietary funds, or complex structured products. On paper, everything seems legitimate, but in reality, these products are often terrible. Imagine you invest in bonds, expecting to earn 5% per year. Great, right? Except you go through your banker. They pocket 1.5% in annual management fees for managing your money, and then they invest it in a subpar bond fund from their bank, which also charges 1.5% in annual management fees. Understand that you're not losing 3% of your total return, you're losing 60% because instead of earning 5% per year, you're only earning 2% due to fees. This is how it works, even if the banker is careful not to explain it so clearly. The result: years of investing with returns barely keeping pace with inflation. In other words, you gain absolutely nothing. I'd even argue that the dumbbells gathering dust in your garage are just as profitable, given that they also benefit from inflation. It's a strange example, but perfectly accurate. The second problem is excessive concentration in real estate. The middle class loves real estate, and it's not necessarily a bad thing. It's a concrete, tangible asset that provides a sense of security. But the problem arises when real estate becomes almost their entire net worth. Many households own their primary residence, and perhaps one rental property, often purchased on a 20 or 25-year mortgage. Ultimately, 90% of their wealth can be tied up in one or two properties located in the same city. Diversification is virtually non-existent. If the local market stagnates or a problem occurs with the property, the impact on overall wealth can be significant. Furthermore, if there were a real estate crisis, you would bear 100% of the brunt. And I'd add that since you live in your primary residence, you don't generate any supplementary income from it. You avoid paying rent, which is great, but no money is coming into your account. The solution: buying real estate with a mortgage is good, but it pairs very well with monthly stock market investments, for example. The third problem is a poor understanding of risk. The middle class is often paradoxical in this regard. They can be extremely cautious about very solid assets like the global stock market, while simultaneously taking enormous risks elsewhere. They hesitate to invest in a diversified global ETF because they believe the stock market is extremely dangerous, yet they don't hesitate to take on 25-year debt to buy an apartment or put large sums into much more speculative investments when a new trend emerges. Risk isn't always where we think it is, and this misperception can lead to very unbalanced choices. And by 2026, there will be no more excuses. If you don't believe me, don't just close the video thinking I'm talking nonsense. Check on Google, discuss it with ChatGPT, and you'll see. Perhaps you won't reach the exact same conclusion as me, as we all have our affinities. But you'll discover that investing in things considered risky actually turns out to be much safer than keeping your money in a savings account for years. Another important factor is the standard of living. The middle class earns enough to invest. What I'm telling you is a fact, as I'm referring specifically to the middle class. They are not earning minimum wage and often have at least two comfortable incomes. The problem is that expenses increase very quickly with income. When salaries rise, the lifestyle almost automatically follows. This translates into a newer car, a larger home, more frequent vacations, more leisure activities, and more subscriptions. This phenomenon is very common, it's called lifestyle inflation. The problem is that by the end of the month, almost nothing is left, and what little remains often goes into sluggish savings accounts. For example, if you don't pay attention and do all of this, you might save €200 at the end of the month at 2% interest per year. You would reach €98,252 in 30 years. If you pay a minimum of attention, you could save €400 per month instead of €200, but more importantly, you would invest it at 10% per year instead of 2%. The result, €825,000 in 30 years. You would have invested twice as much money out of your pocket but have almost 10 times more in your bank account. There's also the emotional dimension of investing. Many decisions are made under the influence of emotions or current events. We often see the same behaviors repeat, buying when everyone is talking about an asset, selling when the market is scary. Buying crypto at the peak of a cycle because everyone is talking about it. Selling stocks when markets fall because fear dominates. This behavior is human, but it often leads to buying high and selling low. This is exactly the opposite of what should be done. Finally, the main problem is often the absence of a global strategy. Many people accumulate products without a real plan. A bit of life insurance, a bit of real estate, a bit of stocks, a bit of crypto, but without an overall vision. Yet, an effective portfolio is not a random collection of assets. It's a coherent strategy. Each investment must have a precise role: growth, diversification, security, or income generation. This is a key principle I often share. But the good news in all of this is that the middle class possesses enormous advantages for building wealth: a stable income, the ability to save regularly, and most importantly, time. Long-term investing works extremely well for those who remain disciplined. The real challenge is not to find a miracle investment, it's to avoid mediocre products, diversify intelligently, and remain consistent for several decades. The key is to start with a clear strategy. Investing effectively isn't hard. You click a button at the end of the month, and that's it, there's nothing to constantly monitor. The most delicate moment is at the beginning, when setting up the strategy. Typically, the best approach is to utilize leveraged real estate, which the middle class is already doing. You couple this with monthly stock market investments through global ETFs, and to a lesser extent, small monthly crypto contributions. Subsequently, you diversify into SCPIs, which are paper real estate investments allowing you to invest across Europe in hundreds of properties and collect rents. Then, as you get older, you further orient towards security with, for example, bonds and gold. And just like that, you arrive at retirement with a profitable and well-diversified portfolio. If you need inspiration, know that I present my own portfolio in a video, the link for which appears above and in the description. Tell me in the comments what traps you've fallen into or if you see anything else to add. Like the video if it was helpful, and subscribe to the channel if you enjoy my content. See you.